Picture this. A bloke earns good money his whole career, solid income, respectable job, hard worker. But by the time he hits his 50s, he's starting over, again. It's not because he was lazy, it wasn't bad luck. It was a slow accumulation of financial decisions that seemed reasonable at the time, but quietly drained every dollar he ever made. Sound familiar? Because across Australia, this story is playing out in millions of households right now, and most people have no idea it's happening to them until it's too late. Today, we're pulling back the curtain on the 9 wealth killers that are keeping Australians broke well into their 40s and beyond. These aren't just abstract financial concepts. These are the real reasons why Australia has one of the highest costs of living in the developed world, yet so many high earners still have nothing to show for it. And more importantly, there's a way out of every single one of them. Let's start with wealth killer number 1, and it might be the most overlooked of them all: living in the wrong city. Geographic arbitrage is one of the most powerful and underused wealth-building tools available to Australians. Here's the brutal reality of how it works against most people. The median household income in Sydney sits around $110,000. That sounds decent until you factor in the median house price of over $1.1 million, according to CoreLogic data. That's a price-to-income ratio that makes homeownership functionally out of reach for average earners. Now compare that to a regional center like Toowoomba in Queensland. Median house prices hovering around $430,000 to $450,000, or Ballarat in Victoria, consistently under $550,000, or Mackay in Queensland, a city with genuine job markets, real infrastructure, and median prices well below $400,000. The income gap between Sydney and these regional cities is not 10 times. It's not even double in most industries. Yet the wealth gap created by housing costs is enormous. Australians have a uniquely powerful version of this strategy available to them, the FIFO model. Fly-in, fly-out mining work in Western Australia pays base salaries of $100,000 to $180,000 per year, while workers maintain lower cost of living homes in regional Queensland or South Australia. That's geographic arbitrage on steroids. You earn like a city professional, live like a regional Australian, and the gap between income and cost goes directly into your wealth building. Perth is its own interesting case. High mining wages, yes, but high local property prices create their own trade-offs. The point is this: where you choose to live is one of the highest leverage financial decisions you will ever make. Most Australians default to it rather than decide it. Wealth killer number 2: hoarding cash instead of investing. Australia has some genuinely attractive savings accounts right now. ING, UBank, and others have been offering bonus rates that have made parking cash feel like a smart move. But there's a danger hiding in those attractive rates. The ASX 200 has delivered an average annual return of approximately 9 to 10% over long rolling periods, including dividends, according to ASX and Vanguard historical data. High-interest savings accounts, even at 5 or 6%, don't come close, and they're fully taxable at your marginal rate. Every year you sit in cash instead of investing, you lose not just the return gap, but the compounding of that gap. Now, offset accounts are genuinely useful for Australian homeowners. Parking extra cash against your mortgage interest is an effective, low-risk return equivalent to your mortgage rate, currently somewhere around 6% for most variable loans. That's a legitimate strategy, but it's a ceiling, not a destination. Once your offset is fully loaded, the next dollar has to go somewhere that generates real long-term growth. The trap isn't saving. Saving is great. The trap is only saving and never crossing the line into investing. Every year of delay in your 20s and 30s costs you decades of compounding. The math on this is unforgiving. Wealth killer number 3: divorce. This one isn't comfortable to talk about, but avoiding it won't help anyone. According to the Australian Bureau of Statistics, roughly 1 in 3 Australian marriages ends in divorce. And from a purely financial perspective, divorce is one of the most destructive events that can happen to long-term wealth accumulation. Under Australia's Family Law Act, assets are divided based on what is just and equitable. Australia operates a no-fault divorce system, which means marital fault is essentially irrelevant to how assets are split. But here's what makes Australia's situation particularly significant. Superannuation is now included in the asset pool during divorce proceedings. This is huge. Supersplitting means that decades of compounded retirement savings, money that was supposed to deliver financial security in your 60s, can be divided between parties. For someone in their 40s with $300,000 or $400,000 in super, this is a devastating reset. Binding financial agreements, Australia's version of a prenuptial agreement, exist specifically to address this. BFAs can be entered into before or during a marriage, and they can set out how assets, including superannuation, will be divided in the event of separation. They're not romantic, but neither is losing your retirement savings at 45. Getting appropriate legal advice before and during significant financial milestones in a relationship isn't pessimism, it's financial planning. Wealth killer number 4, trying to look rich. Australians have a phrase for it, keeping up with the Joneses. But in 2025 and beyond, the Joneses have a buy now, pay later account and a credit card with a 19% interest rate. Afterpay, Zip, Klarna, these platforms have normalized spending beyond income for a generation of Australians. What started as a convenience tool has become a psychological debt trap. When you split a $400 purchase into 4 fortnightly payments, it doesn't feel like debt, but it is debt. And it's debt that trains your spending habits in entirely the wrong direction. Then there's the ute problem. The Hilux, the Ranger, Australia's best-selling vehicles for years running, and incredibly, many of them are sitting on suburban driveways doing zero actual work. The average new vehicle in Australia now costs between $45,000 and $55,000, according to data from the Federal Chamber of Automotive Industries. Driving an $80,000 ute on a $60,000 salary isn't a lifestyle upgrade, it's a wealth destruction machine, with stamp duty on top, because unlike Americans, Australians pay state government duty when purchasing a vehicle. The core principle here is simple and brutal. Looking wealthy and being wealthy are opposite strategies. Every dollar spent performing financial status is a dollar not compounding in your actual financial future. Wealth killer number 5, ignoring equity for salary. Australia doesn't have Silicon Valley's startup equity culture. That's true, but it has something that many Australians completely overlook: employee share schemes, or ESS, available through major ASX-listed companies, including Commonwealth Bank, BHP, Wesfarmers, and many others. Under Australian Taxation Office rules, ESS arrangements can be structured with real tax advantages. There's a concession allowing up to $1,000 of discounted shares to be received tax-free under certain conditions. Beyond that, shares acquired under qualifying ESS arrangements may have their tax point deferred, meaning you don't pay tax until you actually sell. For an employee at a large Australian company, routinely ignoring ESS offers and focusing only on base salary is leaving a meaningful component of total compensation on the table. Over a 10 to 15-year career at a growing company, this compound equity position can represent tens of thousands or more in additional wealth. The mindset shift required is to stop thinking of your job as a salary and start thinking of it as a total compensation package. Salary, super contributions, ESS, bonuses, these all stack. And in Australia, The super guarantee alone, currently 11.5% of your ordinary earnings, is a wealth-building mechanism that most employees barely think about. They should be maximizing it. Wealth killer number 6, sitting on the sidelines. Here is a fact that should make every Australian genuinely uncomfortable. The ASX 200 has roughly doubled over the past 10 years, not including dividends. Including dividends reinvested, the total return picture is even stronger. And yet, a significant proportion of working-age Australians have zero direct investment exposure outside of superannuation. Super is a start. It is not an investment strategy. It's a compulsory savings vehicle that for most Australians under 40 is nowhere near sufficient to fund the retirement lifestyle they expect. Australians have a fascinating and uniquely local psychological barrier around investing: property. Australian culture has for generations treated residential property as the investment. Shares? That's gambling. A house? That's real. This cultural bias has left entire cohorts of Australians completely unexposed to equity markets that have delivered extraordinary long-term returns. The data from Vanguard and similar research consistently shows that time in the market beats timing the market. Missing just the 10 best trading days in a decade, 10 days out of roughly 2,500, can cut long-term returns in half. Every year of delay compounds that opportunity cost, and every year spent waiting for the right time is a year of returns permanently lost. Wealth killer number 7, sunk cost loyalty. Australia has a strong union culture and, in many industries, a genuine tradition of employer loyalty. In contexts like the Australian Public Service, the APS, job security is real and meaningful. But the wage growth? The APS salary structure is famously slow, incremental, predictable, and for ambitious earners, it can mean years of real wage decline relative to inflation and market rates. According to Australian Bureau of Statistics job mobility data, Australians who change employers typically receive pay increases of 10 to 20% on average, significantly more than the 2 to 3% internal increments most organizations offer. Over a 5-year period, the cumulative income gap between a job switcher and a loyal stayer can reach $80,000 to $100,000 or more. The Fair Work Commission sets minimum wage floors, and it does so annually, but those increases are rarely enough to match what the external market is willing to pay for skilled workers. And in an economy where inflation has been running well above target, real wages for loyal employees have effectively shrunk. Loyalty is a virtue. Financial sunk cost loyalty, staying somewhere because you've been there, not because it's the best place for you, is a wealth killer in slow motion. Wealth killer number 8, high interest debt. The average Australian credit card interest rate sits around 19 to 20% per annum. Let that number sit with you for a moment. 19%, at a time when the best savings accounts offer 5 or 6%. The gap between what debt costs you and what savings earn you is the most important number in personal finance, and for Australians carrying credit card balances, that gap is enormous. Buy now, pay later platforms add a new dimension to this problem. Afterpay and Zip don't always charge traditional interest, they charge late fees that can accumulate rapidly, and more insidiously, they make high spending feel low cost. Research from ASIC has shown that BNPL users are more likely to cut back on essentials, take out additional loans, and experience financial hardship than non-users. And then there are personal loans in the 2025 and 2026 RBA cash rate environment. The RBA's rate tightening cycle pushed variable personal loan rates well above 10% for many lenders. In this environment, every dollar of non-mortgage consumer debt is a genuine emergency, not a lifestyle accessory. The debt hierarchy is simple. Pay off high-interest debt first. Every dollar of credit card debt eliminated is a guaranteed 19% return. No investment in the world offers that certainty. Wealth killer number 9. Buying too much car. Australians spent an average of between $45,000 and $55,000 on a new vehicle in recent years, according to the Federal Chamber of Automotive Industries. And unlike Americans, who already face significant vehicle purchase costs, Australians also pay stamp duty on top. The rate varies by state. In New South Wales, stamp duty on a $50,000 vehicle runs to over $2,000. It's a cost that often gets forgotten in the excitement of a new purchase. The Toyota Hilux and Ford Ranger have been the top 2 selling vehicles in Australia for years. Many are genuinely purchased for legitimate work purposes, but many are not. A $75,000 to $85,000 dual-cab ute financed over 5 years is consuming income that, invested in an index fund for 10 years, could generate meaningful wealth. Novated leases deserve a special mention here. They're uniquely Australian, a salary packaging arrangement where your employer makes vehicle lease payments from your pre-tax salary. In theory, this can be tax-effective. In practice, for many Australian workers, particularly those not in the highest tax brackets, the tax savings are smaller than the dealer's promise, and the FBT implications can erode the benefit significantly. A novated lease is a tool. Whether it's the right tool depends entirely on your individual tax situation, usage, and income level. Get independent advice before assuming it's automatically advantageous. So, there they are, 9 wealth killers. 9 ways that Australians, including high earners, smart people, hard workers, quietly bleed wealth across their 20s and 30s until they look up at 40 and wonder where it all went. The good news? None of these are permanent. Geographic flexibility is a choice you can make. Investing doesn't require expertise. Platforms like Perler, Sharesies, and Stake give Australians access to diversified, low-cost index fund exposure in minutes. Comparison sites like CanStar and Rate City exist specifically to help you find better rates on savings, mortgages, and insurance. The tools are there. The question is whether you'll use them before 40 or spend the years after 40 trying to recover from not having used them before.